right? So we have to think about, are there budget entries, are there proprietary entries? Okay, and we have to record both. So number one, Able Agency received a warrant for its fiscal 2007 appropriation of $2.5 million. So on the proprietary side, I'm going to debit the fund balance at the Treasury for $2.5 million. I'm going to credit unexpended appropriations for $2.5 million. Same thing I did in exercise 19.3. Okay? Same thing that's shown in the case. Then I'm going to record a budget entry. Appropriations realized of $2.5 million and unappropriated authority of $2.5 million. Okay? Again, these are shown to you on starting on page 760. Okay? And then going forward. Number two, the Office of Management and Budget apportioned $600,000 to Able Agency for the first quarter of 2007 fiscal year. So I'm going to move this from unappropriated authority to apportionments. Right? This is all those steps that we were talking about. Allotments, apportionments, all those pieces. Okay? So number two is just a budget entry, no proprietary entry. Number three, Able Agency's Chief Executive allotted $500,000 of the first quarter appropriation apportionment. Okay? So,
can I stop you for just a second?
Yeah.
So in the book, when it was saying that we needed to record the remaining quarters, you didn't do that on that for the remaining after the $600,000?
Right.
For the first quarter, then it said you should also do an entry for the remaining quarters?
Yeah, it did in the case, you're right.
Do we need to do that?
You don't need to on this problem because it didn't say to recognize the rest of those. The reason it was doing that in the book was to show you, it was trying to illustrate that in reality they would do it quarter by quarter. But here, they don't necessarily signal you to do the rest. If you did it, that's fine.
Well, that's not I did, but I'm more concerned about in real life would it need to be done.
In real life, you would do each quarter by each quarter. So in the case is really where they're showing you too much information as opposed to this problem where they're just doing a quarter. Does that make sense? Because in real life, you're not going to recognize the whole year at once. You're going to recognize it quarter by quarter. Does that help? Okay. Let's see. Number three moves it from apportionments to allotments. Okay, so we're taking $500,000 of this $600,000, and we're moving that to allotments. Number four, obligations incurred during the month for equipment, materials, and program costs amounted to $128,000. So you're taking $128,000 of the $500,000 and moving it to undelivered orders. Does that make sense? So there's this ladder idea. That's shown to you on page 762. There's a chart on the top of 762. It shows you the ladder. Right? When you add it and then subtract it and then add it and then subtract it on down the way. So you're moving it from bucket to bucket to bucket to bucket. Okay? Number five. Number five, we get back to a proprietary entry and a budget entry. Goods and services ordered during the prior year and to be charged to obligations carried over from 2006 fiscal year were received. You have what they were, you're given the information of what they were obligated for and then what their actual cost was. Okay? So in our proprietary, go ahead.
Does it matter which order we put them in there?
No.
Okay.
You mean budgetary or proprietary? No.
Okay.
No. So in the proprietary entry, I'm going to record the actual costs. Right? The actual cost of my inventory, $21,000. The operating program A expenses, $6,200. Program B, $2,500. And all that goes to accounts payable. Okay? So I'm going to pay for it. Then I'm going to debit unexpended appropriations, still in the proprietary entry, and credit appropriations used. Right? Okay? then my budgetary entry has to account for those obligations, not just what the actual costs were. Okay? And let's see, where was this shown? Page 765, I think. Delivered orders. There's one on 766. So you're going to do your budgetary entry here to account for the total of the obligation, right? Because the obligation is a budget piece. We did something like this in the SLGs and the state and local governments, right? When we did the encumbrances. Remember that? We did encumbrances. We set aside money saying it's going to cost this much. Then you have to reverse the encumbrances and spend the money. So that is in essence what we're doing here. The there's $300 left over, $300 difference between what you obligated, what you expected, and what you actually paid. That $300 comes from or goes to, depending on how you look at it, expired authority. Because this is being charged against 2006 appropriations. Right? And we're in 2007. Okay? So at the end of 2006, all of your unused appropriations would have gone to expired authority. Does that make sense? So any budget authorization you hadn't used would expire. And it gets included, right? It gets recorded, I should say, as money that was already appropriated, but your budgetary authority has expired, but it still sits there. So that in the next year, if there's anything outstanding, it gets applied to that, which is what's happening in this case. It's a carryover, right? It's a way of carrying over that money, or that budget. Number 6, same type of entry, except we're in the current year, or we're charging it against the current year, I should say. So you're going to do the same type of thing. Proprietary entry is going to record the actual costs of $128,000. You're going to debit your unexpended appropriations, credit your appropriations used. Budgetary entry, you're going to take care of the obligation, and in this case, because it's not expired authority, you're going to take this $2,000 that's left over and put it back to allotments, right? Or take it from allotments, depending on how you look at it. Because it's in the current year, right? They're current allotments, as opposed to expired budgetary authority from the previous year. Does that make sense? Conceptually, at least. So in number 5, you were using money from the previous year, right? So it technically had gone into expired authority. That's why you used that $300 from last year. In number 6, you're using money from the current year, so it's in your allotments. That authority has not expired. Okay? At the end of 2007, anything that's left in your allotments will expire for 2007. Okay? But then it'll sit there and get carried over to cover any obligations that were made in 2007 that need to be covered by that budget authority. Okay? Number 7. Number 7's on 778. Depreciation for the month of October was estimated at $200, chargeable to overhead. Straightforward. We're going to debit our overhead expenses and credit accumulated depreciation, just like you would normally do. Number 8. Materials issued from inventory during October were for Program A, $18,000, Program B, $7,000, and general overhead, $3,000. So you're simply recording the expenses in those amounts and taking it out of inventory. Okay? So You would do this in regular for-profit accounting. Number 9. Liabilities placed in line for payment by the U.S. Treasurer totaled $145,000. Debit accounts payable, credit disbursements in transit. Because that disbursement has to come from the Treasury, right? I have to put through a warrant. That warrant has to get signed off, and that's where the payment comes from. Okay? So there's more steps here. Number 10, last one. Other accrued expenses at October 31st, 2006, not previously recorded, were Program A 1,000, Program B 6,000, and General Overhead 1,500. So number 10, you're going to debit the appropriate expenses and credit accrued liabilities. Okay. You're going to recognize that as unexpended appropriations and appropriations used in the proprietary entry. And in the budgetary entry, you're going to recognize the allotments and the expended appropriations unpaid. Okay? Because these were not previously recorded.